Warren Buffett is considered the greatest investor of all time. If you had invested $1,000 in his investment company when it was founded, today that amount would be worth over $30 million. Returns like these may seem unattainable, but how did Buffett actually achieve this? The answer lies in his understanding of what most people don't and his commitment to a few fundamental principles that you can adopt in your daily life. Keep watching, as by the end of this video, you will have learned all these principles. We look for three qualities when hiring people: intelligence, initiative, or energy and integrity. If the person doesn't have the last one, the first two can be detrimental, because if you're going to have someone without integrity, it's better that they be lazy and not very smart. The worst combination is someone who is intelligent and energetic without integrity. The renowned investor states that investors tend to behave in a very human way. They get euphoric in bull markets, look at the recent past and say, "I made money last year, I'll make even more this year." And then they decide to take out loans. Or their neighbor, whom they thought was less smart, made a profit, and so they enter the market due to influence. They always look through the rear-view mirror, and when they see a period of profit, they invest everything, pushing prices up. When they don't see profits in the rear-view mirror, they decide it's a terrible place to invest, regardless of what's happening with the underlying businesses. This creates huge opportunities. He was taught by Ben Graham to invest based on quantitative analysis, looking for cheap things. He learned this in 1949, which had a great impact on him. For years, he followed what he calls the cigarette butt strategy. It's like walking down the street, finding a wet, horrible cigarette butt, but one with one last puff left. You pick it up, take that last puff, and throw it away. It's free. It's cheap. He followed this strategy for a long time, but admits it's a mistake. While it is possible to profit, one does not make large-scale gains. Today, he prefers to buy extraordinary businesses at a fair price rather than common businesses at an excellent price. The magnate firmly believes that one should only expect to make money on things one understands. For him, understanding doesn't just mean knowing the product, but knowing how that business's economy will look 10 or 20 years from now. For example, he understands Wrigley and its chewing gum market, which won't be affected by the internet. Therefore, he can predict that, a decade from now, the demand for doublemint, spearmint, and juicy fruit will remain stable. This understanding is part of what he calls his circle of competence. The biggest mistakes he made were errors of omission, not commission. These are cases where he knew enough to act, but hesitated. A painful example was when he almost bought Fannie Mae about 20 years ago, but didn't. This cost Berkshire Hathaway about $5 billion. He doesn't regret mistakes in areas he doesn't know, like Microsoft, because he doesn't feel capable of making money in fields outside his circle of competence. According to him, the great opportunities in life should be seized. The veteran emphasizes that not many significant actions are made in one's lifetime, but when a big chance arises, one must act boldly. He believes it would be better if upon graduating from university, everyone had a card with 20 punches representing the significant financial decisions they can make. This would make people think much more before acting. The businessman is unwavering about keeping the companies that Berkshire Hathaway wholly owns, even if someone offers far more money. He likens selling one of these companies to selling a child just because someone offered a lot of money. He wants his partners to know this so they won't be disappointed. To him, reputation is an invaluable asset. He emphasizes that the trust of his partners, shareholders, and the business communities he works with is more valuable than any amount of money. He believes that maintaining integrity and non-negotiable principles is what sustains Berkshire Hathaway's longevity and success. Protecting that reputation means keeping one's word and acting in ways that inspire trust, even when large sums are at stake. Only in cases of great dissatisfaction with management or significant changes in the economic characteristics of the business would he consider selling. Finally, the Oracle of Omaha explains the concept of intrinsic value. This is the value that a business would generate in terms of cash, discounted at the appropriate rate, until the end of time. He highlights that, for stocks, this value isn't printed on the certificate as it is with bonds. The analyst's job is to estimate how much a company will pay in the future. If you buy a farm, an apartment house, or oil, the idea is the same. You're spending money now to get more in the future. This is the only reason to invest. He concludes by saying that when investing, he always thinks of the company as a whole, assessing whether it will be able to generate enough cash to justify its price. If he can't answer this question, he doesn't buy the stock, avoiding speculative investments, especially in internet companies. When evaluating a company, he always considers buying it entirely, even if he's only acquiring a part of it. He looks at how much cash the business can generate and when this will happen. A fundamental part of assessing intrinsic value is understanding how future profits can be reinvested to generate even more returns. He notes that companies with solid business models and consistent margins have the power to turn each dollar of profit into more value over time. This includes reinvesting in new products, expanding markets, and increasing operational efficiency. For him, businesses with a high return on capital employed provide the best long-term value. He notes that, ideally, the return on reinvested profits should grow over time. For example, Berkshire Hathaway has never paid dividends to its shareholders, but its capacity to distribute increases as the value of its businesses grows, allowing the company to reinvest and compound its capital internally. The central question is whether the company, acquired at its current value, will be able to generate enough cash within an adequate time frame to justify the investment, especially considering current interest rates. For him, businesses with a high return on capital employed provide the best long-term value. He notes that, ideally, the return on reinvested profits should grow over time. For example, Berkshire Hathaway has never paid dividends to its shareholders, but its capacity to distribute increases as the value of its businesses grows, allowing the company to reinvest and compound its capital internally. If this question can't be clearly answered, he avoids buying the stock, preferring to stay away from companies he doesn't fully understand, like those in the technology sector. The veteran doesn't feel comfortable investing in businesses he doesn't understand deeply. Another important principle for him is avoiding excessive debt. He believes that many companies compromise their stability by leveraging too much in pursuit of rapid growth. This type of risk can lead to financial vulnerability, especially during economic recessions. The magnate prefers companies that grow organically and sustainably, based on retained and reinvested profits, thus ensuring robust growth resilient to crises. He warns that many investors fall into the trap of following trends without considering whether they have the necessary knowledge to assess the risks. The circle of competence is a central concept. It means focusing on areas where one has solid knowledge and avoiding sectors where this understanding is limited. He argues that this doesn't mean missing out on opportunities, but rather maximizing the chances of success in the choices made. Know your limits and invest within them is advice he follows religiously. The investor confesses that when it comes to technology companies like those in the internet sector or other areas he cannot evaluate accurately, he chooses to step back. He reinforces that while there might be a temptation to invest based on rumors or momentary trends, that is not part of his strategy. To him, investing is different from speculating. The philanthropist also highlights the importance of simplicity in his investment choices. He prefers business models that are clear and can be explained simply. This approach avoids unnecessary complications and protects him from financial traps. He often says that if you can't understand how a company makes money, it's better not to invest in it. This philosophy helps keep his portfolio focused and efficient. He believes that patience is one of an investor's greatest assets. He mentions that often the best opportunities arise in times of uncertainty when others are fleeing the market. Having the courage to act in difficult times and the discipline not to rush during times of euphoria are part of his long-term strategy. He says, "The market is a mechanism for transferring money from the impatient to the patient." If someone buys stocks because they heard about them in a casual conversation or saw recent performance on a chart, they are not truly investing but gambling on luck. This is why he seeks businesses that can produce predictable and sustainable returns. He believes that by acquiring companies with the potential to generate consistent long-term returns, true success in the investment world can be achieved. The focus is not on how many people are recommending a stock or how it is being discussed in financial circles, but on how much financial return it can deliver in the long term. To conclude, he reiterates that success in investing depends on making well-thought-out choices and deeply understanding the businesses in which one invests. Patience, the ability to act when necessary, and clarity about what is inside or outside one's circle of competence are factors that distinguish a successful investor from someone who is merely taking chances without solid foundations. Buffett points out that regarding his privately held companies, Berkshire Hathaway's philosophy is not to sell, regardless of the amount offered by third parties. He believes the companies that make up Berkshire Hathaway are not just financial assets, but communities of people who share long-term values and goals. To him, selling one of these companies for an attractive price would mean betraying that trust and the principles that form the foundation of his reputation. The only situation in which he would consider selling is if he were deeply disappointed with the company's management, or if there were a drastic change in the business's economic characteristics. The billionaire places immense value on the competence of the management teams of the companies he acquires. He also discusses how he assesses a company's intrinsic value. In other words, he views investment as an exchange of money now for more money in the future. When investing in stocks, he makes an analogy, saying that the stock certificate does not show how much money the company will pay in the future. That is the analyst's job. He reinforces that assessing intrinsic value is more of an art than an exact science. For him, companies that have the ability to expand and maintain a competitive advantage over time are especially valuable as they maximize return on invested capital. Buffett points out that if someone had $100 billion to buy Coca-Cola, the question would be whether that amount would be justified by the financial return the company would provide over 2 or 3 centuries. The discount rate used to assess this return is less important as the time horizon extends, but the essence of the decision is always how much money will be generated and when it will happen. The philanthropist stresses that any financial investment boils down to calculating the cash return, whether it's a farm, an apartment building, or oil underground. The essential question is, how much return will you get? When will that return come, and how certain is it? When he calculates a company's intrinsic value, he always thinks as if he were buying the entire company, not just a part. He concludes by emphasizing that without having a clear answer to these questions about a company's potential return, he simply does not invest. This careful approach keeps him away from speculative investments and companies whose future viability he cannot confidently predict, especially in the technology area, such as internet companies.